What does Warren Buffett see in a balance sheet that sends most investors running to Google for help? While everyone else obsesses over stock prices and predictions, the Oracle of Omaha quietly reads financial statements like bedtime stories. Today we're diving into Warren Buffett's balance sheet analysis, the same principles that built Berkshire Hathaway into a $700 billion empire. By the end, you'll know what Buffett looks for and the red flags that make him walk away. Let's decode the Warren Buffett way. But first, smash that like button and subscribe if you want more book summaries like this. Buffett doesn't just glance at balance sheets, he interrogates them. While most investors get lost in complex financial jargon, Buffett asks three simple questions. 1. Can I understand this business from its balance sheet? 2. Is the company built to survive storms? 3. Will it make me richer in 10 years? Let's start with the basics. Every balance sheet has three parts. Think of them as the three pillars of any business. Assets, what the company owns. This includes cash, inventory, equipment, and everything else of value. Liabilities, what the company owes. These are the debts, obligations, and bills that need to be paid. Shareholders' equity, this is what's left over. It's the true value that belongs to the owners after all debts are paid. Now, here's where Buffett's genius kicks in. He doesn't just look at these numbers, he looks at the story they tell. A strong balance sheet tells the story of a well-managed, profitable business. A weak balance sheet, well, that's often the beginning of a very sad story. Warren Buffett once said that when he looks at a balance sheet, he's essentially asking, would I want to own this entire business? Here are the key metrics that help him answer that question. First up, debt levels. Buffett treats debt like fire. A little bit can be useful, but too much will burn down the house. He typically avoids companies where total debt exceeds annual earnings.
Why?
Because when economic storms hit, and they always do, companies with heavy debt loads often don't survive. Think about it. If you're personally drowning in credit card debt, how hard is it to weather a job loss? Same principle applies to businesses. Buffett looks for companies that could pay off all their debt within 3 to 4 years using their current earnings. That's his safety margin. Next, return on equity, or ROE. This is probably Buffett's favorite number on any financial statement. Here's the simple calculation. Take the company's annual profit and divide it by shareholders' equity. What you get is a percentage that tells you how efficiently a company turns shareholder investments into profits. Buffett loves companies with consistent ROE above 15%, but here's the key. It has to be consistent year after year. A company that posts 25% ROE one year and 5% the next? That's not consistency, that's a roller coaster, and Buffett doesn't do roller coasters. Buffett also checks whether a company can cover short-term obligations with short-term assets. This is called the current ratio, current assets divided by current liabilities. A ratio above 1 means the company can meet its near-term bills. Buffett doesn't demand sky-high ratios, but he avoids companies with ratios consistently below 1, since that signals liquidity stress. Finally, let's talk about book value. This is where Buffett has evolved over the decades. Early in his career, he loved buying companies trading below their book value, essentially buying dollar bills for 50 cents. But he learned something important. Sometimes cheap is cheap for a reason. Now he focuses less on the absolute book value and more on how efficiently a company grows that book value over time. A company that consistently grows its book value by 12 to 15% annually? That's what gets Buffett's attention, even if the stock price seems expensive today. Now let's talk about what makes Warren Buffett immediately close a financial statement and move on to the next company. These are his deal breakers. First red flag, deteriorating asset quality. Buffett pays close attention to inventory levels. If a company's inventory is growing faster than its sales, that often means they're having trouble selling their products. Same goes for accounts receivable, that's money customers owe the company. If this number keeps growing while sales stay flat, it might mean the company is struggling to collect payment, or worse, they're inflating sales numbers. Second major red flag, hidden liabilities. These are the financial obligations that don't show up clearly on the balance sheet, but could devastate the company's future. Think about pension obligations to retired employees, or potential lawsuit settlements. Buffett once avoided entire industries because of these hidden time bombs. The key is reading the fine print. Those footnotes that most investors skip contain the real story about a company's true financial obligations. Here's Buffett's ultimate red flag. If he can't understand the balance sheet after 10 minutes of reading, he walks away. Complex financial structures usually mean management is either hiding something or doesn't understand their own business. Buffett's rule is simple. If you need a PhD in accounting to understand how a company makes money, it's probably not making money the right way. Let's look at how these principles play out in real life. When Buffett invested in companies like Coca-Cola back in the 1980s, what did he see in the balance sheet? First, minimal debt relative to earnings. Coke could pay off its obligations easily. Second, consistently high ROE. The company was exceptionally efficient at turning investments into profits. Third, growing book value year after year. The business was getting stronger, not just bigger. But here's what really excited Buffett. Coca-Cola's assets weren't just buildings and equipment. They owned something more valuable than gold: brand recognition and customer loyalty. These intangible assets don't always show up clearly on balance sheets, but they create lasting competitive advantages. Take another example: why he loved Wrigley. On paper, Wrigley looked simple: solid margins, low debt, and steady returns. But what truly mattered was its intangible brand power. People have been chewing Wrigley's gum for over a century, and they're not going to suddenly switch to a no-name alternative. Buffett believed that brand loyalty, though invisible on the balance sheet, was worth billions. Looking across Buffett's best bets, Coca-Cola, Wrigley, American Express, you see the same pattern. A strong balance sheets that could weather any storm. Consistent profitability year after year. A business is simple enough to understand completely. Intangible assets like brands that endure for decades. The balance sheet wasn't just a financial statement for Buffett. It was a crystal ball showing him which companies would still be thriving decades later. So there you have it. Warren Buffett's approach to balance sheet analysis isn't about complex formulas or insider secrets. It's about asking the right questions. Can I understand this business? Is the debt manageable? Are profits consistent? Will this company be stronger in 10 years? Your homework: pick a company you're curious about, find their latest financial statements, and apply these Buffett principles. Ask yourself those 4 questions and see what story the balance sheet tells you. If this helped demystify balance sheet analysis for you, hit that like button and subscribe for more investing insights. Remember, in investing, knowledge isn't just power, it's profit. Until next time, invest wisely. Thanks for watching. This is Guide to Wealth, where powerful ideas meet practical action.